Welcome. It's finally here. The biggest earnings of the season, Nvidia. Rain, hail, or shine, miss, disaster, or beat. One thing is certain, volatility. So let's dive in and discuss all the details to keep your hands and arms in the ride at all times. And let's break down the earnings of the most important stock in the world. Let's roll the tape. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks were very mixed on Wednesday, led lower by Target, which was down 22.5%. Similar stores, Dollar General and Dollar Tree followed suit, and that's because Target's earnings were horrid, not good at all, and this did send stocks lower in the morning. However, a lot of those losses were pared, especially into the afternoon, and that gave us the day we saw here today. Very mixed trade across industrials, comm services, real estate, utilities, financials as well. We saw Visa and MasterCard get hit in excess of 1%, but the rest of financial and credit services looking pretty good, and that's because of a Senate hearing that's currently going on with regards to these companies' market positioning as well as the fees they charge. I think we're really going to start to see even more regulation in that space, and that's why they were down 1.4 and 1.32% respectively. On a bright note though, we saw healthcare very green as well as software. It sort of bucked the trend we saw here in technology with Google, Amazon, Tesla, Microsoft and Nvidia all red on the day, as well as the broad semiconductor market, which was actually led lower today by Qualcomm after management's commentary wasn't taken too well. And then diving into the sectors, what we really saw today was outperformance in healthcare, energy, materials, and these are sectors that haven't done too well in the last couple of weeks because of a Trump administration. I think the market is still grappling with what a Trump administration is going to look like, his cabinet picks, how it's going to affect funding, spending, the deficit, and a lot of pessimism that was in these names, healthcare, industrials, getting pared back a little bit, and that's why we saw outperformance in these names. However, the S&P 500 today was largely flat, and then the stocks that underperformed the SPY was XLK, the technology sector. Real estate, home builders were a dumpster fire today and have been for the past month. We saw financials underperform, discretionary underperform, and then staples. So anything that was cyclical, rate sensitive, and somewhat defensive didn't do so well today. But we saw that the majority of stocks here at the start of the day, the majority of sectors, I should say, were actually lower into the morning. This was on the back of Target's news, as well as some of the geopolitical concerns that still underpin this market. We'll talk about what happened with gold when we talk about the charts. But again, similar to yesterday, we saw a low put in, and while the majority of sectors didn't go out and gain on the day, we saw about half of them gain with the S&P 500 flat and very constructive price action from the lows. But when you look at it in aggregate, net, there wasn't much of anything. But then when we actually split everything up into its factor and size segment, what we really saw today was actually pretty positive trade, all things considered. I mean, these were just positive coming into the open. It was pretty red all day. The only factor segment that actually did lose here today was actually large cap value. Everything else did gain, and we really saw that in the price of the RSP, the S&P 500, and mid caps. Mid caps were the outperformer, especially mid cap core, exactly like yesterday. They outperformed as well. But let's actually talk about some of the market movers here today. Target down 22%, a very ugly day. The stock fell on Wednesday because it slashed its full year guidance, missed on revenue, missed on EPS, and had its worst one-day performance since May 2022. And I looked at the earnings and I saw three major problems. Number one, there was just too much inventory and lackluster third quarter sales. Sales in important categories such as home goods remained soft, and the CEO and his executive team came out and their tone on their outlook for the holiday shopper was not that great. If you want a blueprint on how to tank your stock price, go listen to this earnings call. It was very ugly, and I think you're gonna have to see like 3 or 4 quarters of solid results to gain the market's trust, right? I think this is probably going to go lower. You're probably going to see Target closer to 150 15 over the next couple of months. However, when we look at Williams-Sonoma, now this is a small cap, and if you own a small cap quality ETF, Williams-Sonoma is actually at least going to be in the top 10 positions in that ETF. It was up 26% today. It beat on top line, beat on bottom line. It boosted its outlook for the full year. They also said some commentary around China tariffs, and pretty much Williams-Sonoma came out and said it's prepared to reduce exports to China if tariffs increase, and the management team looking at prudent capital allocation with the trade war that's probably going to ensue over the next couple of years between China, Southeast Asia, and pretty much the rest of the world against the US. And now looking at Nvidia, they released their earnings after the bell. This is what everyone's waiting for. The initial reaction here is actually down 2.12%. This is as of 4:27 New York time. And guys, these earnings were actually fantastic. They beat the EPS expectation of 75 cents with 81 cents reported. Revenue came in at 35 billion. The market was expecting 33.1 billion. They had record data center revenues that accounted for 30 billion of total revenues. And guidance for the next quarter in revenue is expected to be 37.5 billion plus or minus 2%. GAAP and non-GAAP gross margins are expected to be 73% and 73.5%. So we actually did see guidance come in line. We saw a healthy beat on the top line and the bottom line. Everything you are expecting from this name, except the reason why we're down today actually has to do with that gross margin guidance. If we actually have a look at the overall earnings, right, you can see right here, gross margins, 75.1 in the same quarter last year, 74.6. So we actually saw a decrease here in gross margins. What does that mean for their market share? I think that's the reason we actually saw the stock come down. That, as well as just heavy expectations into this name. That being said, Nvidia continues to defy expectations, especially in revenue, earnings per share. And look at these numbers. These numbers are absolutely crazy, especially for a mega cap. The quarter over quarter numbers, look at the year over year numbers as well. And pretty much this is the final quarter before we start to see the Blackwell revenues come into place. Great earnings, but the margin profile for the stock is why we're seeing material weakness here in the after hours. And this is probably not a good thing. It sets a sour tone for the rest of the month of November. That being said, I think you really still want to look for a bottom and buy the dip, because with Blackwell revenues coming in the fourth quarter and first quarter 2025, I think we're going to continue to see healthy beats into 2025 for this name. It just depends how margins are going to hold up. And to be honest, 74.6% gross margin, still very, very strong, all things considered, but missed analyst expectations in that department. And we are seeing lower margins and guiding for lower margins in the fourth quarter and first quarter. And so the street has to grapple with that, along with everything else the market is grappling with at the moment. When we take the broader market and look at the trends, things still look very, very healthy, especially medium-term trends. Longer-term trends look very healthy. The shorter-term trends, not that great. Things are starting to fall apart here, but the shorter-term trends tend to be very, very noisy. We are seeing deterioration, and if we lose the 50-day moving average tomorrow on a red day because of Nvidia's earnings, that could spell trouble for the directional trend for the rest of November. So all in all, guys, things look solid, but we are starting to see some weakness under the hood. And diving into the charts, you can see a bit of mixed price action. The IWM seems unfazed with Nvidia's earnings. It's flat here in after hours, but gained 0.31% for the day. The RSP, very similar, gained 0.34%, flat here in the after hours. The Q is looking a little bit weak, again, flat on the day, but down 0.33% here in the after hours on Nvidia's earnings. That's not going to bode well for semis. I still think it was very good earnings, and just the expectations going into them were just a bit high, but great earnings nonetheless. Fundamentally, the company is extremely sound. And then we also see the S&P 500 down 0.18% here in the after hours. So this is probably going to lead weakness into the end of the week and probably into the month of November. But I do think with Nvidia's earnings, guys, if we do get a material pullback, we want to buy that dip, because I think fundamentally everything still looks really great for the company. All in all, though, looking at markets, the S&P 500 was flat today. The NASDAQ lost ever so slightly. Mid caps gained the most. The SP 600 profitable small caps were up 0.1%. It was a fairly mixed to positive day, all things considered. Yield rose, so too did the dollar. And normally you see commodities fall when you have that, but gold actually gained 0.63% today. And that goes to show that the market is still grappling with some of that geopolitical tension. When you see the dollar rise and gold rise too, there's definitely something fundamental happening, and that has to do with just the stuff with the Ukraine and Russia. We sort of get this 24-hour news event where it's in our minds and out of our minds, and now Nvidia is at the top of our mind, but there's still a lot happening in that area of the world, and that is reflected in the gold trade. We did see silver down 0.122%, reflecting the stronger dollar and telling us that the gold trade here is really just a trade on geopolitics, people wanting to hedge ahead of that. We also saw crude down 0.26%. Bonds fell. It really was a day for equities, I guess, except large caps, but all in all, guys, when we actually look into the charts, dive a little bit deeper, what we saw today was we opened right here for the day, then we actually sold off. Look at this wick, and then buyers came in and took us pretty much to the open of the day. If we actually hop on the 1-day chart and just zoom in, you can see we slid here early in the morning. This is on the back of Target's news, and then pretty much made higher highs, higher lows into the end of the day. The S&P 500 was virtually flat on the day. Very volatile price action, and look at where we found support on the day, guys, right at the gamma flip. If we go back to the daily chart and then just zoom in, we found support right here on the gamma flip, and I do think that this is a crucial level, a crucial line in the sand right now, but we're going to have to see how the market reacts to Nvidia's earnings tomorrow. That being said, I wouldn't want to take shorts below here unless we get a tangible close below with the bears clearly overpowering the bulls. Looking at the Nasdaq 100, very similar situation, except while the S&P 500 is in positive gamma, we're in negative gamma right here, and the gamma flip acting as very strong resistance. And I think with Nvidia's earnings, I think we're going to continue to see that. And at the start of the week, I said we're going to get a move up into the gamma flip zone. It just depends what happens next. If we go up and move higher after Nvidia's earnings, or if we go lower. And by the looks of their earnings and how the market is reacting here in the pre-market, I think we probably see some weakness. However, I don't think we're actually going to break the put support, or probably this level right here. I think the 20,400 level is probably where you can start to pick up shares, particularly in the Qs. Looking at the RTY though, the put support acting as strong resistance. And guys, while we are seeing a lot of buying and selling at these areas, I think the market is looking very constructive for us to move higher. I mean, if the IWM wanted to sell off and move lower, it could. This does look like a base is being formed, which would be a higher low relative to this low, and this low right here. In the context of a 52-week high, I think this is looking largely constructive. I think we see a little bit of churn here in the markets, especially if we can get the RTY breaking positive gamma again, as well as the Nasdaq 100 if we can get above that positive gamma. But expect more churn, especially with Nvidia's earnings, before we see any more material upside. Looking at the RSP, we saw some very, very solid support right here. And if we do get a pullback to this area here tomorrow, probably buy that dip. A lot of these markets, the Nasdaq 100, the S&P 500, sort of forming like a low, a higher low, looking to move higher probably into the end of December. So I think, if you're constructive on equities, which I am, because earnings are growing, margins are expanding, we're in a cutting cycle, there's a lot of tailwind seasonality, buybacks, etc. The Trump administration, this is just an opportunity for you to get long, guys. You want to be long. We're going to go higher into the end of December, into January, into year end. Material downside, 10 to 15% sell-off will come in the February, March period 2025 circa there, maybe as early as January, but don't look for material downside right now. There's too many tailwinds. You just want to buy dips and ride the coattails to 61, 6,200 into the new year, guys. If you are looking to hedge your portfolio, I think gold's a pretty good bet right now. It's well off its highs and has quite a lot of geopolitical tailwinds. As you can see, we put in a bottom right here, and when you zoom out, that's actually a higher low relatively speaking. It's been very, very strong all year. I think it's going to go take out its highs. So if you're looking for a hedge, you can actually look at gold. I actually don't mind getting into a bit of treasuries. If you want to collect some yield, look at something like TLT, guys. The yield is very, very good. It's like 4.5%, and we are starting to see somewhat of a bottom formed here. I think we do move higher, and I do think yields are going to pull back into the December period. We are just seeing a little bit of churn, but if you want to collect some yield, I think this is a great spot for treasuries, all things considered. The majority of the move higher in yield is probably done, and that's going to be supportive for bonds and equities into the end of December. So all in all, guys, look, I think equities are looking very constructive. We're forming a base here at the gamma flip for the S&P 500, the Nasdaq 100. We're forming a base for the Russell 2000. We're forming a base at the put support. All of these are higher lows relative to the most recent lows we put in, and this is setting us up to go higher into the end of the year. And guys, look at the Qs, actually only down 0.18% here in the after hours. When I opened up my chart, it was like down 0.4%, 0.38%. And let's actually quickly have a look at what Nvidia was doing. At the time when I started the recording, Nvidia was down about 2.2% in the after hours. It's now down 1.87%. We are still seeing a tiny bit of weakness here in the Qs. So only down, wow, the Qs nearly flat in the after hours. Very, very interesting. At one point, it was down 0.4, 0.38%. So very interesting trade right there. Nvidia just down 1.91%. I think, if we do move further, guys, there's an opportunity to just buy the dip. Those earnings were very, very solid. It's just margins. Those were very solid earnings. It's just expectations that were really high into these earnings, but great earnings nonetheless. So Nvidia hovering around that 1.5 to 2% mark. I think that's where we're going to see the trade. And it's still above the 140 mark. So all in all, yeah, Nvidia, it's had a fantastic year, absolutely crazy year. A lot is baked into the price, but I do think we probably go see all-time highs. Maybe not this week, maybe not next week, but definitely into the end of the year. These earnings will be supportive for the stock. We're just going to see near-term volatility. And diving into seasonality, it is that time of the year when we start talking about the Santa Claus rally, the end of year rally, the end of year run. Probably one of the best reasons as to why you want to be invested during this time of year, because this time of the year, this seasonal period, tends to be very, very bullish. Choppy, but bullish. And now this is one of the trades we're going to look at over the next couple of days, over the next couple of weeks, I should say. The Thanksgiving trade into the Santa Claus rally, which pretty much goes from Tuesday before Thanksgiving, so next week, into the second day of the new year. And the S&P 500 sees average returns of 2.58%. Look at this hit rate. 59 up years, 15 down years, a 79% win rate, with the average win being 3.78% and the average loss only being 2%. So the risk to reward, not super great, but because of the win rate, it makes the trade exceptional. The Russell 2000 sees more alpha, but that tends to happen in a higher beta index. Average return 3.34%, 77% of the time, that's the win rate. But look at the win-loss ratio. That's really, really good. Almost 2 to 1. That's exactly what you want to see, and risk is skewed to the upside here. History tells us that normally stocks move higher from now into the end of the year, or from next week into the end of the year. But we still should see choppiness, because this is where we are right now in the month of November. We're in this period where we can actually see a little bit of digestion to the downside, a little bit of a capitulation to the downside. This is a 0.6% move to the downside from these highs right here to the lows. However, what we normally see in the month of November is a higher low, and then we actually go ahead and break the highs we made earlier in the month for an average return of 1.82%. And what's really driving the market right now is actually earnings, guys. S&P 500 earnings estimates for this quarter is in excess of 8%. Analyst expectations were 4%. That's really something to be said. But if you actually look at how earnings estimates have actually come up from 2020 when we had COVID, earnings estimates have just really moved up. The only index that's in an earnings recession is the Russell 2000 right here. We are expected to see in excess of 45% earnings growth through 2026. And as the S&P 500 has outperformed in earnings, this is set to continue from now until the end of 2026. We're looking at 28% earnings growth, and very much the same in the mid-cap spectrum. And guys, looking back to 2020, the S&P 500 is actually up about 90% from the start of 2022 right now. Yet the valuation of the S&P 500 has roughly stayed the same, and this largely has to do with what we're seeing right here, earnings growth. The same is somewhat true in the S&P 400 and the S&P 600. The index has actually got cheaper here in 2020, really going to show the earnings-driven rally we've seen in the last 5 years. Yes, there has been a lot of multiple expansion, but there's also been a ton of earnings growth, and it's very clearly illustrated right here, and that is set to continue. And yes, valuations are high, but a lot of that is being backed up by earnings. And we are expected to see a broadening out of earnings, and that is going to translate in narrowing performance between the 493 and the Magnificent 7. And this is because we should start to see a narrowing in earnings growth because all indices are going to participate, large, medium, and small, and this will result in a narrowing of equity returns. That being said, the Magnificent 7 is still expected to outperform in 2025 by 7 percentage points. We've seen pretty stark outperformance here in 2024 year to date, an exceptional outperformance in 2023. So yes, gains are decelerating. We're still seeing relative outperformance, and it's why you want to be allocated to the Magnificent 7 names and to these large cap tech names. And at the end of the day, guys, when we look at what Cisco did in the early 2000s and what Nvidia and tech valuations are doing right now, Cisco's rise in price was simply not backed up by its earnings. With Nvidia, earnings is backing up the price action. We've seen immense earnings growth that has resulted in immense share price appreciation. If earnings wasn't backing up the technicals and the fundamentals, I would be worried. I wouldn't be as bullish as I am right now, and I would be very concerned. But we are seeing a rally driven by earnings, and yes, there is multiple expansion. Don't get me wrong, but it's nowhere near as severe as the year 2000. Just look at these two charts to compare the pair. Now, diving into the macro, we got Goldman Sachs GDP estimate, and they actually lowered their fourth quarter GDP tracking estimate from 2.6 to 2.5. And this was on the back of the retail sales data. Goldman believed it just wasn't as strong to justify anything above 2.5%. And we actually are going to talk about the risks in the macro environment right now. Something that no one is really talking about is that market pricing embedded inflation has actually increased based on 2025 estimates. Look at 2025 realized inflation, sitting at about 2.5%. If we actually look at market implied inflation at the start of the year 2025, it's at 2.85%. In other words, the market is actually pricing in a little bit of an uptick in inflation next year, telling us that if we do get inflation reacceleration, that is largely priced in already because the market is incredibly efficient. We also got a note here with regards to the labor market from BOFA, and pretty much to sum up, this year's holiday hiring period could be slower than the last. The deceleration in job growth over the last few months is being felt more broadly, and that could affect the holiday season. However, while job growth is slowing, overall labor productivity is a bright spot. It's been very strong coming off the lows we saw here in 2020. But when I look at this in aggregate, I would say that the productivity growth is actually in line with what we saw in 2020. Now, this could turn significantly to the upside. Then things would get much, much different. If this breaks above the trend and we start to see something like that relative to the COVID trend line, then productivity will be a huge benefactor to the overall employment picture. But as it is right now, I would just say that we are seeing a reversion back to the mean. Looking at earnings for the rest of the week, guys, the big name Nvidia is obviously done. We spoke about it in this past video, but tomorrow we have a couple of Chinese names before the open, Baidu and PDD. We also have John Deere and Intuit after the close, and that's really it for the week, guys. We have gone through this week. It was a hectic week, a crazy week, but we've come through largely unscathed so far. And the only thing that can really derail us for the rest of this week is the PMIs, which we have on Friday. We have the global manufacturing and composite PMIs. And then tomorrow we have initial jobless claims. That's really it, along with existing home sales. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.